Right, we're going to get started today. I wanted to thank everyone for joining us. There we go, we're already starting. Investing to Disrupt, a blueprint for venture building success. Okay, that seems to be topic du jour that everyone's talking about. I wanted to thank our panelists for joining us and making the time today. I'm going to give them an opportunity to introduce themselves before we get started. Harald?
Hi everyone, thanks for joining despite the rain. I think there will be special cookies or I don't know, special points for anyone who came. So kudos for that. I'm Harald. I run the venture building program at SC Ventures. Just to give you an idea of scale, we have a portfolio of about 35 ventures. So 35 ventures across the globe, by the way, so not just in Singapore. We run ventures in the footprint of the bank. And we build ventures according to the themes that we call the high conviction themes, from digital economy. So you may know of Trust or Trust Bank here in Singapore. Mox in Hong Kong would be part of that ecosystem. Digital assets. If you were with us earlier today, we have a number of ventures around digital assets, not just crypto. I'm sure most of you know what real world asset means. And we're doing a bunch of really good things, and including the launch of Baer today. SME and trade, we have a number of solutions around SME and trade, and sustainability and inclusion. So in a nutshell, that's what we do. We have a whole methodology around it. We really believe in it. It's something that enables us to innovate, create optionality, agency to the bank in a very lean manner. And we're now seeing some real traction around some of our ventures. I'll stop here because I could go on and on. But yeah, that's me and SC Ventures.
Hi.
Turn it on. Yeah, thanks.
Hi. I'm Alvin from the Singapore Economic Development Board. You may know us from our 60 years plus of history on attracting large businesses to Singapore. Now that growth engine continues to exist and powers the majority of our economy. It comes a point in time where Singapore really needs to create another engine of growth, which is how do we get our new businesses, new ventures, startups to become global scale. And in the last 10, 20 years, we've already got a good crop of unicorns coming from this region. The question is, what more potential is there and how do we accelerate that piece? So my team was really set up to incubate and build global ventures that are global from day one, and can use Singapore to scale as that platform to become global, right? And our path is to really work with partners who have strong advantages that can accelerate. So firstly, large corporates who bring advantages. So I have a project currently with Harald to do that, something in the space of real world asset tokenization. I've worked with Jonathan in the past on something similar in wealth tech. And you can see, if corporates bring that advantage, it's very, very significant in boosting a new business plan. I also start to work with, in particular, global founders, because a lot of the unicorns globally either are thinking about spinning out new businesses in adjacent growth. Somewhere in the unicorn's life journey, the growth starts to become one of optimization. And to get to another S-curve, the founders have to essentially build new businesses to get there. And nothing quite like Asia, where there's a lot of market gaps still and sort of latent potential to do that. Founders are also inherently, with their DNA, is very restless. A lot of the unicorn founders will exit and build their next big thing, and we want to position Singapore essentially as their hub. And so I'm one of the essentially leadership members within the New Ventures group, of which we have two arms. One, a venture building arm that brings together programs, our own pool of venture builders to lend to businesses to accelerate their go-to-market, as well as a venture capital arm in my compatriot team, which essentially looks like de-risking investments into some of these new ventures from Singapore.
Hey, hi. So I'm John. I lead the global innovation team at Julius Baer. So JB, we're a Swiss private bank, pure play private bank. We focus on wealth management for the ultra wealthy. My team essentially focuses really on how we look at validation, and we've done validation in the sense of driving the proof points of why we need to build something, our journey into venture building essentially is one of those multi-pathways that we have for scaling. The goal essentially is we don't want to be doing POCs for the sake of doing POCs, or just to for the fun of it. We want to be able to bring POCs to scale, and what we have is we have our own innovation methodology and approach that allows us to go from a successful POC into multiple pathways for scaling in terms of, can we build it ourselves? So I run a full stack innovation team with designers, product owners, engineers as well, data scientists. Basically, they act like a startup team that can build anything, even from Gen AI solutions. We've dealt with doing some of that. With the EDB, we partnered on exploring venture building in the space of wealth management. So that's one aspect. The second aspect of partnerships, where we partner with the likes of like Tenedy, which is a fintech ecosystem to identify startups they can work with. The third one is where we can put capital to it, so venture funding. And finally, the last bit is really around if everything else fails, maybe we build it ourselves and we go down that path of venture building. We're still in a very early nascent stage of our growth. We're exploring some collaboration opportunities with Harald as well. And I think fundamentally our approach is one of open innovation, open collaboration. Let's work together as an industry to find ways that we can solve sort of the most pressing challenges that we have.
Great, thank you, Jonathan. And very similar to this, I'm Chetan, by the way, Franklin Templeton, and very similar to how Jonathan described Julius Baer's strategy in terms of innovation and driving change. Ours is quite similar. We have 3 main verticals. So as most of you know, we're in 160 countries, manage 1.4 trillion in assets. We're in the top 5 or top 10 global asset managers, which is a very traditional business, but looking to maintain the cutting edge of innovation and how things are evolving in the industry. So the way we do it is effectively, we've got an incubation arm, which was started in 2019 from our Silicon Valley office. We manage about 30 companies in the portfolio across incubation and the next leg, which is strategic investments, which are larger Series A through C type of rounds. And then, of course, we've got venture capital growth funds, crossover funds that can do larger deals for more established, quote-unquote, startups or companies about to go pre-IPO. So we are very focused on technology, just by virtue of our roots in Silicon Valley. And I think if you ever hear Jenny Johnson, our CEO, talk, you can just tell how passionate she is about technology and change and disruption. And so we have, similar to Julius Baer, partnered with Tenedy for our Asia Pac incubation hub. We've also got a lot of experiments in-house. I shouldn't call them experiments, they're really commercial efforts. And we're really trying to drive change through internal builds as well, through our own project teams.
Great, thank you so much.
Thank you, guys.
Sounds a lot
Technology
better.
at its best. There we go.
Okay, this is why it was switched off. Can you guys hear me okay? I don't, yeah, there we go. See, simple solve. So thank you for that introduction. As you can tell, everyone on our panel is from TradFi institutions or government. And I'd love to hear your thoughts on incorporating venture building into these traditional models, right? And what are some of the challenges you faced? Are there naysayers? How do you deal with them? And also kind of, how is innovation best leveraged for transformation goals? Harald, do you want to start first, or Alvin?
Alvin, do you want
Sure. Government, is good at a few things, not so good at others. So I don't want to say that, we want to replicate what founders or businesses are at. But in broad strokes, I think we are there to de-risk, and we are also there to direct resources, especially at the economy level, to certain big bets we want to double down on. So I'll give a bit of examples of both, and also give some sense of how we are ourselves having to transform to do that more effectively, and at the speed and scale of what startups need to have. Firstly, on de-risking, it's not that corporates don't innovate. Corporates do, but there are different degrees of innovation. I mean, you can innovate at core, but to really innovate at the edges or specifically going into adjacent growth spaces, to take out 2 entrepreneurs, put in $2 million seed check, to grow an entire new business where the key metric is about proving the MVP, getting on board your next 5-10 customers, where your actual revenues are a drop in the ocean out of your core, takes a long way to go, as well as a lot of corporate investment and sort of commitment at the C-suite level. And so that's almost not really natural, right? So where government then comes in is to play the catalyst role. It's to also say, if you are putting in these level of resources to do that out of Singapore, doing that at scale in terms of building a certain portfolio of number of pilots, experimentation, venture builds per year, we will come in to de-risk that process, both financially and also with our people and resource, to advise you and guide you along the way. And frankly, when Singapore government puts out some of our people and sort of stamp of validation on certain types of things, it does go a long way, because it typically comes also with unlocking of resources, which is my second point. In some of the venture sprints that we've been on, especially if we put our own bench of venture builders, right? And when I say a bench of venture builders, again, you may think, what kind of venture builders does government have? Essentially, we've hired some of the founders who are from the outside, complementing also some of our own entrepreneurs, people who are from EDB, but actually have a more entrepreneurial edge. Because this mix allows us to sort of unlock EDB's networks in a way that it has not done before, and also to go into certain business model matching and testing that, again, government has not fully gone into. And so essentially, by being involved in some of these projects early on, for some of the sprints that we've been on, we've unlocked 25% to 50% of the validations. In some of the POCs and first partnerships that's unlocked, a bunch of them, especially if they're in the B2B venture space, and EDB has a pretty decent B2B organization at the heart of our core business, have been pretty solid. So again, those things are where we would like to lend resource and lower friction for businesses, for founders to do what they do best.
Maybe I can talk a little bit about the need for innovation. And I would say, I agree with Alvin. I think big corporates innovate all the time, but they innovate while making sure that the core remains intact. And there's an absolute vital need for the core to continue to function. So you can't disrupt that, right? And so in order to do real business model innovation, you need to do it outside of the core. And that's what we do at SE Ventures, right? We recognize the core is very important, but if we want to innovate, try new business models, try new ways of doing business, incorporating DeFi in TradFi, for example, to go back to your example, but by respecting the way that the regulator is asking for us to do things, we need to do it externally. And so we do it this way. On the notion of maybe ecosystems, I think having a base in Singapore for us has been extremely important. We build and we run ventures throughout the world, but we have our commercial headquarters in Singapore, so most of our people are actually in Singapore. We have an entire team of support, from functional support, business support, tech support, would all be based out of Singapore. And having that ecosystem very vibrant and very active is important for us. And having it as well, the right regulations, the right mindset, the right network, and all of that is really important. And that's the reason why I think we're so strong in Singapore, because we recognize that ecosystem, and that ecosystem is very important. And having the agencies, government agencies, be part of that ecosystem is something quite different from other places. Like I said, we do, I'm not going to name other countries, but we do it in other countries where it's not always the case.
Chetan or Chetan, do you have anything to add?
Oh yeah, sure. Thanks. No, I think coming back to Alvin's point earlier about the whole point of innovation and de-risking, right? I think fundamentally, when we talk about innovation for a corporate itself, I think a lot of times corporates have forgotten the way, or rather the DNA in itself, on how to actually innovate, or how do you change narrative. One of the things that we found over the last 2 years that I've been running the lab has been internally, all the challenges that have come out have all been in what we call Horizon 1 space, right? It's all, everything internal coming from the ground up, because everyone is looking to use innovation to solve their day-to-day challenges. However, it's not moving us forward in the sense where we've seen from a top-down strategic standpoint, or even coming out of the lab looking at different opportunities, is where we are seeing the 3 to 7 year horizon itself, so Horizon 2, Horizon 3. fundamentally, innovation is not here to solve that Horizon 1 problem, right? You have an automation need, that's not innovative, that's not innovation anymore. It's about how we actually validate at every stage of the process so that we can reduce the risk that we have so that we're able to then move forward and take those larger investments. I think one thing corporates do very well is say, we need to have a very big check size before we can start anything. I think that's where we need to change the narrative or the mindset to say, look, let's start small and it can grow big later on.
I'll just add a couple of additional points because I think you've mostly covered it. One, absolutely correct. The core cannot be touched. It is all about preserving the core and building ancillary capabilities that expand the core. Secondly, what drives it? Is it internal talent or is it external talent? I think from experience, what I've seen is while the desire might be to give employees the opportunity to express their creative spirits, you really have to look to independent startups and free thinkers to really drive that change. So I think that's what we've seen at least. We look to the startups for ideas, we'll help them, we'll partner with them, we'll figure out a way to make things happen. The third point I would make is Singapore. Why Singapore? I mean, we're a US-based company, only about 9% of our AUM assets are in Asia. Because I think ultimately from going from Silicon Valley to Singapore made the most sense from an ecosystem to ecosystem play. There's a lot of good depth here to see, good talent pool, and I think that's why, to address your question, how do we make the jump, you gotta pick the right spots to make the jump as well, because if you don't have the right talent and the right idea flow, you're just sort of spinning wheels in terms of this, trying to be innovative for the sake of being innovative. So I think those are the only three additional points.
I was just going to react on the internal versus external because it's an ongoing quest, right? The way, and I'm not saying we've sold for it, by the way, but we generally start from internal. So we have a group of what we call our intrapreneurs. Intrapreneurs are subject matter experts in specific areas of the business. They understand their business extremely well. They understand the pain points, but they've never done it before, right? They're not entrepreneurs, to your point. And so while we can start with them, we'll need to pair them at some point with that external talent that can think outside of the box, that can do things in a leaner manner, not with a big check that you were mentioning, because at SC Ventures, we don't cut big checks from the get-go. We go lean. I'm sorry. We do go lean, and we do so in really the lean startup way. Validation, iterations. You mentioned sprints. We run sprints until we have enough validation, and then we go to bigger checks. But that external validation is extremely important. There's good things, by the way, with internal. I think in the context, especially of TradFi versus DeFi, you all know the collapse of FTX. FTX came to see a lot of financial institutions in Singapore, or around the world actually, to invest in them. We passed, and I don't want to be dancing on people's grave. That's not my point. But the fact that we had that internal understanding of segregation of roles, segregation of assets, is something that made us understand that, as a matter of fact, this was not a business that we could trust, and we decided to pass, right? So I think these are some of the good health, sanity checks that we do from internal, while always seeking external validity, either from founders or from investors or from regulators, etc.
Thank you. So I'm actually kind of debating which way to take this at this point, because there's a lot of great things that you guys have said, but I'm going to go with the fact that we have a number of fintechs who are attending, and the question always comes up around how do we engage with corporates? What are they looking for? If I want to partner with a corporate, how do I present myself? How do I set myself up for the greatest chances of being able to scale with them and build with them? So on that note, how do you kind of define returns? How do you define returns versus a longer term horizon versus a shorter term horizon? Because the reason I ask that question is investors are always skeptical about corporates building, right? Because they think we're not really cutthroat, quote unquote. So any thoughts you have on that?
Well, I want to debunk that myth, because for me it's a myth. Actually, we are investors. Most of us are investors. We're EDB is an investor, as a matter of fact. We're banks or big asset managers, so actually we know how to make investments. Very often you hear people saying CVCs are too strategic, they're not focused on financial KPIs. That's not true. We're 100% focused on returns, but we also need to have a strategic vision. I would not invest, SC Ventures would not invest in something that does not fit our vision to rewire the DNA in banking. If it's about something else, about medical or education or whatever, we probably won't do it because it doesn't fit our mission to rewire the DNA in banking. But we will invest and we will build ventures that promise strong returns. It may take a little bit longer because we have our own processes, we have our own ways of validation and so forth. But we're measured against IRR, MOIC, the exact same thing as VCs outside would measure the success of their companies.
Anyone else wants to weigh in on that question?
I can
Sorry.
add a few thoughts, kind of very similar. Oh, wait.
Yeah.
There we go. First of all, we are not financial investors, so if you're approaching us as a fintech and expect us to just invest on the basis of it's a great deal, that's not what we do. We have to justify even the smallest check size to our CFO and CEO on the basis of why are we doing this on a strategic basis. So that's the one advice I would give to fintechs is you have to come with us for the journey just as much as we're going to come with you on the journey and understand our business and where we're trying to go with it. The tactical step to take is read the corporate presentations, understand the strategy, hear the CEO speak. The CEO, when she speaks, she'll articulate exactly where we want to go. Secondly, I think in terms of how we can work better, I think it's not always an easy journey, but the prominent thing to focus on is how we can, what capabilities do you bring to the table versus what we can bring to the table. I mean, with our size, we're as a large asset management, we're bringing distribution, we're bringing investment expertise, we're bringing the brand and the credibility. You have to come to the table with something differentiated to offer. And that's usually why we look to the fintechs is you do have the technology, you do have the team, the experience to prove something different for us. So I think those are the only two tips or messages I would give. It's not that corporates are difficult to work with, but we do have, in a fintech, you can make a decision in a snapshot. We have, I don't know how many committees to go through to approve $1 of budget. So maybe you want to add to that.
Yeah, maybe I can add to that one. If there's any kind of advice I would give to any fintechs is forget about the technology, focus on what is the problem you're trying to solve. Way too often we've seen fintechs come and say, I've got this great technology that's going to change the world for you. How? We don't know that. We need to see what is the problem we're trying to solve. And I think fundamentally that's something that I've seen over the number of years I've been working with fintechs, is the ones that have been successful are the ones that are solving a problem, not selling the technology itself. So the technology will solve the problem, but more effectively. I think that's about how we do it.
That's a great point. You wanted to know, I'll just say one thing, which is, so we have so it's not a committee. It's a group of people that we've put together. We've called the Brain Trust. And the Brain Trust is, I wish it was our concept, it's actually a borrowed concept from creativity.inc. I don't know if you've read that book. It's a great book about Pixar and how they came up with the best animated movies. And very early on, they had created this board of advisors who were decorrelated from the business, right? So they were not going to be threatened by the business of the new movies that were going to come in. But they were experts in their own domains, and they would give unfiltered feedback to any movies that would come, and that would, that they would pitch the movies to them. So we borrowed that concept. We've made our own. It's a bunch of advisors from internal, external people, tech entrepreneurs, VCs, bank board members, etc. And every month we push a number of ventures to them, and we evaluate together the potential of that venture. And we evaluate basically, so back to the point, we evaluate them mostly on 4 criteria. And I agree with John. The first thing is always the problem. What problem are you trying to solve? Is the problem big enough? Is it relatable? Is it a real tangible problem? Can we measure it, etc.? We start with the problem. Second is the solution. We apply a framework called DVF. If we have HCD or product design people here, it's desirability, viability, feasibility. Do people like it? Are they gonna buy it? And is it technologically feasible? So sometimes my French comes back. And then the third criteria is the people. Do we like the team? Is the team relevant? And the fourth is how they're going to use the funds. Are they actually going to build this, or are they going to spend it on hotels and first-class tickets? And based on all that, we make a decision.
Maybe I'll just add to that on everything that the panelists have spoken about is all true. The question is then, how do you still identify the best, right? So on our site, we've spoken to over 200 corporates and worked with a good number of them. At the end of the day, corporates need to be successful, by doing a portfolio of innovation approaches. Part of it could be, investing in startups and building startups, and another could be building your own. But fundamentally, the learning point that we have is this: if the corporate hasn't articulated corporate sponsorship at the top level, if the corporate hasn't have various innovation vehicles and structures in place, it's going to be very, very difficult because you're going to be a hit and miss type situation. So first and foremost, in identifying people we want to work with is whether the corporate is innovation mature. And that's kind of how we term it internally. And for that to happen, some of the things that I've spoken about in terms of smelling it out, because it's easy for a fintech or any startup, frankly, to be enamored by, this large name is trying to work with me. But this large name could be just trying to incite a few things. This large name could have a very specific interest in investing in you from a financial standpoint, which is quite different from a strategic standpoint. But if it's a strategic standpoint, you want to figure out exactly what is that. My advice is that one or two advantage that you need as a startup and that the corporate has agreed to unlock, whether it's a procurement advantage because they're going to be a large customer, whether it's a R&D, IP advantage, but in a collaboration, and not too many more things, because the moment a corporate has 5 things you want to do with them, it's just going to be super hard to nail down. So those things I think are quite key to what you need and sort of that quid pro quo arrangement.
Got it. Another question that fintechs are interested in is also around whether it's investing or partnering with different stages during the life cycle of a venture, right? So how do you kind of define when you come in, and as you grow with the venture, how do you identify, success points, or even, I think more critically, when you see warning signs, how do you intervene, and how do you kind of get them, on the right path during that journey?
Again, I can start, but so we've defined the venture building journey according to 3 main stages. We have called them, and I don't think we've really reinvented the wheel, by the way, in any shape or form. But we define the first stage as incubation. And so during incubation, which is what you guys have with Tenity, is we'll seek to really get as much validation as possible, right? And validation could be from the market, validation could be from investors, validation could be from end users, etc. But that's what we do during incubation, right? And typically, we'll give what we call a pre-seed ticket. I'm not going to give any amount, by the way, but we'll give a pre-seed ticket, and so that the fintechs can go and get these validation, right? Once we have enough conviction, we go to what I call the brain trust. If the brain trust is positive, we go to a formal committee, and that investment committee will decide to invest or not. That becomes a little bit more serious money. It's what we call a seed ticket. With seed, they can build the tech, recruit people, apply for licenses if they need to apply for licenses, really start building their actual startup, right? During the phase of what we call then acceleration, it will be about building the business case, building the model, building the tech in a sprint manner, as Alvin was saying, up to a point where we have an actual product and tested, internally externally in a small group, externally in a bigger group, and until it's fully live. And for us, that's the last stage, which is what we call commercialization, when the entity is fully set up, the whole team is there, there's a board and all that.
And maybe Harald, you could also elaborate a little bit on the check-ins that we have and
Yeah.
the support that we.
Yeah. So we assign. So in my team, in the venture building team, we will assign incubators, which will help our entrepreneurs develop their business idea. But we have also our entire functional support. So we have our own mini bank, as if you wish to say so, in SE Ventures, with compliance, risk, tech, finance, HR, etc., all within SE Ventures, so that if we need to go fast, if we need to decide on setting up an entity, we can do it fairly quickly. If we need to apply for licenses, we'll get a compliance check before it goes to MAS for validation, etc., etc. So we do these checks along the way as the venture grows, and we seek external validation, because obviously, the goal of these ventures is not to be reincorporated into the bank for most of them. It's actually to go and live their own life. So seeking external validation is extremely important for our ventures.
Anyone else?
I think on the point of validation, the advice we always give companies is, what are the metrics to put in place? Because part of it is, when do you know when to kill? And at the end of the day, metrics need to be set for the right purpose. So for example, I've worked with product companies trying to spin out services businesses. And the first metric that management has was, how do I improve COGS or profit margin? And that's never a good start for a new venture. So we work alongside them to look at, if it's a SaaS business trying to build, you're looking for customer churn, you're looking for how much CAC, how do you lower that along the way? And if you can get it in the first, fundraise and the second fundraise, what kind of state do you need to be compared to competitors? And if you hit those, great. If you don't, what are the reasons? And if the reasons are valid, the team has pivoted, so on and so forth. And it's worthwhile to continue to put a check behind it. Those are valid, but otherwise don't keep a zombie alive. So I think at the end of the day, the validation is both in the market traction. The validation as you spin it out is also the external capital that comes your way, because fundamentally, when you get on this business as a corporation and as a venture, the competition is as much another startup in the world, and that startup's growth path is the amount of capital that it can raise. And so it's no longer one where you're just growing new things by your own corporate resources. And I think that's equally important as well.
Just one other point for the fintechs is, I think we're all global organizations, including EDBI, which has a global footprint. And my advice would be, don't get enamored by just, because you're in Singapore and all of a sudden you see a corporate with a huge US distribution arm, that you go, okay, I can go to the US right away. That is not the way I would design your strategy. Along with all the KPIs and the incubation that needs to go, be put in place, we will take you there eventually. But if you start going back and forth and start thinking, I'm starting in Singapore because I can get to the US or Europe, you've clearly not thought through your value proposition. The value proposition needs to be in Asia. You need to nail your market. We've had experience with a couple of startups that have done exactly that and gotten distracted and really not paid attention to what is the proposition at hand. And there's a reason you're in Singapore and you're in Asia, so make advantage of it. The US market has its own share of challenges and tribulations to sort of nail down. So that's been my sort of practical experience with some of these, how to manage the pitfalls of any strategy going forward.
So to add to that, as you guys evaluate ventures and founding teams and C teams, what are kind of the three things, and it could be more, what do you look for as kind of core values or attributes that may define the success of a venture? Is that too heavy of a question?
No. I want to be specific, but I think, again, that framework, problem, solution, people, right? So very, very good problem. Problem is extremely clear. It's something we like. The solution is doable, right? And it's going to make money. The team is a credible and successful team. I would go back. I would say yes, we should start with a problem, but if we like a technology, a very specific technology, we'll dig a little bit deeper into that tech. And I think in our case, it was blockchain is something that we think is very interesting for many different use cases. AI, who hasn't thought about doing an AI project in the past 8 months? These are still things that we'll look into, even if we haven't identified the problem just as of yet.
Yeah, and I guess what I'm asking is more specifically the qualities maybe that you're looking for in venture builders or venture building teams that may either say yes, this is someone that we want to have build a venture, or this may be a bit of a warning sign.
On the people side?
People
Yeah.
side, from a talent perspective.
Yeah. Well, on the people, I'll just give my perspective, right? Because a lot of our entrepreneurs come from the bank, and so long-term bank employees have many qualities, but they also have one flaw, which is they like their salary a little bit too much, and that's not always compatible with building a venture. So finding the right balance between being a little bit risk adverse, which is good. We like risk adverse people, but at the same time, wanting, owning and wanting to own that solution to the point that you're willing to put a little bit more than just your next 6 months is a good sign of quality in entrepreneurship for us.
I think from our standpoint, it's actually, we do hope more employees get enamored to develop their own, but it's been mostly external talent that we've had to really look at. And I think it comes down to, you've simplified it into 3 perfect bullets, but the team itself it's about, do they understand the business that they're trying to solve for well enough? And it typically shows pretty quickly if they do or not. Their years of experience can be very helpful, but if they're trying to go into a business where they haven't fully thought through all the competitive dynamics, the existing, for example, if I ask a question, who's your competition? And I say no one.
Yeah.
I immediately go,
Yeah,
okay.
That's a
you have
commonality.
not thought through this.
If there's no competition, there's no business. So,
Right.
yeah.
So that's a simple question I think anyone trying to test out a team should do is, who's your competition? They say no one. Wrong answer. Maybe not, but you know what I mean. And the second thing is, I think their ability to, again, risk averseness. It's good to be very bullish and be a go-getter, but you need to understand how you're going to build the team, build the finances, manage your cash flow. You can't just be going out with a plan to spend it all, and you have to be a bit more fiscally conservative in that sense.
Got it. I just got the 5-minute warning sign, so I'm going to do one more question and then I'll open up for Q&A. Last question is around the ecosystem, basically, for innovation within the TradFi models, right? So when we had talked earlier, we talked about how a lot of it is very siloed. So is there an opportunity to collaborate across traditional institutions or traditional business models and partner more on innovation? And how can we do it, basically?
Well, I think we've really evolved. I think initially when we started, we wanted to own the entirety of the business that we were launching, and I think that's very common for CVCs, by the way, and for governance reasons and a number of different reasons. And over time, you understand that actually it's better to own maybe a smaller percentage of the business, a business that's worth something. And again, who defines that it's worth something? It's the market. So you need external validation. More and more, I think, so we've evolved in 2 ways. More and more, we're doing partnerships and co-creations. So I think we mentioned, it's not a pure chance that these people are on this panel. We are trying to do things together. So that's one. The other thing that is also something that we've evolved is we're willing to give more equity to the founders, and I think that's, a lot of corporates are reluctant to that. That's a mistake. You want to incentivize your founders with the right equity stake, so that they feel ownership in the business. So.
I think on the government side, I think there's a lot of value in cross-sharing problem statements. So it could happen where if you're in the same sector, just like this room, you could come together. Increasingly, we also believe that for Singapore to pick a few big bad areas for sectors to grow, and you start to realize that actually multiple parts of the value chain should come together and solve problems together, and that's multifold more effective. So for example, in the area of sustainability and climate tech, I'm a firm believer that different parts of the value chain needs to come together. Corporates have a large role to play in adoption and testing out solutions, so on and so forth. And so if we can identify the few corporate players that are non-compete but getting solutions through and creating vehicles to do that, that's better. So for example, we've funded and supported a vehicle called Wavemaker Impact, which are essentially collecting various corporates in the value chain to pull together problem statements. They find founders to go build the ventures and go to market in the world. The corporates are both invested at the fund level, which participates and gets back in success of the ventures at portfolio scale, as well as the option to obviously directly invest in the ventures that make sense. And so if we can get more of these vehicles out, I think everyone can win.
One of the partners is the founder of Property Guru, right?
That's right. That's right.
I think fundamentally, if we look at our problem statements, it's pretty much the same across the board. There isn't, if we don't collaborate, we're gonna lag behind. Especially in today's context, when we look at technology itself, it's all been democratized, right? All of it, a lot of it is open source, a lot of it, everyone has access to the same technology, and everyone has, it's about how we use it, and we need to build competitive advantage. The best way to do that is by coming together, working together, so that we are able to make it better. And I think it's also to learn from each other on how we can solve some of these problems. I mean, when it comes to Gen AI, I think a couple of months ago, I was just discussing with a couple of other Swiss banks as well, around like how can we actually leverage this technology as a whole, rather than just say keeping it for ourselves. There's no way we can keep it for ourselves. It's completely democratized in today's context. So with the rapid advancement of it, we can't move fast enough. So we have to work together to be able to do that.
Great, all right. So on that note, any questions from the audience? Yes.
Hi, my name is Venkat and I represent Templeton. I have a question specifically for you, Harald, which is that ventures typically are trying to solve a real world problem and fast forward the entire process of breaking the solution out and then creating the right rails for a rapid scale up. Yet many of these ventures, which are funded by financial institutions, are held to very different standards. So let's say there's a venture just trying to solve a market problem. It's able to kind of surmount a lot of the other reg and the governance related issues. And yet the parent is holding it to a very different standard when you're trying to put the same solution back to to the FI which is funding it.
Yeah.
I understand there are very clear lines of business, governance standards, but how do you reconcile the two? Because one is, for example, regulated by someone like MAS or a local regulator, while the other is, you may have the licenses, but then it's really for the person who consumes that service to evaluate, whether you meet the benchmark or not. So, thank you.
It's a great question. I think I think we want to bring the bank along, okay, in the ventures that we build. We also recognize that what you can do in a very small, lean startup takes a different pace, takes a different, approval system than in a big organization. But if we can bring you guys along, and by the way, so the bank is a shareholder in that company, a majority shareholder in that company. And if we can convince you that, look, actually it's working, we're getting clients, we are getting the right licenses, we're getting the right validation along the way, that use case can transcend to the bigger group. We need to do it better, by the way, but I think it's absolutely within our willingness to keep on doing so, So
Thank
it's
you.
working purpose.
I think there was a question behind.
Yeah.
Thank you.
So hi, my name's John. I'm running a startup out of Sweden. we're here for the FinTech Week. So thank you so much for letting us be part of this panel as well. I think this is quite interesting because we have developed our startup with a corporate. So from the start, we have been working closely together with the corporate, and it's been great. Of course, we've been growing fast over the years, got funded immediately from day one. But then, of course, working with corporates always means that you, at some point, will reach the buy or build decision, right? So what happened to us is that we're still partners, we're still working together, but after deciding not to acquire us, they sidetracked and built a copycat and launched that in some of the verticals. And obviously this is a dilemma for startups and entrepreneurs that are working with corporates, because you spend a lot of time working closely with the corporate, you almost optimize your startup for that particular corporate, and when the acquisition doesn't fall through, because obviously that was in the back of our minds the entire time. So how do you deal with that?
Well, I can't speak for your corporate, okay, so I don't know what happened. But I would just say that, okay, our stance, by the way, is, so going back to what Deepak was asking, our stance is absolutely we need to bring the bank along. That's an absolute necessity, right? We're not innovating on our side, building our own little things. We need to do it with the bank, okay? So that's number one. Now, does it mean that the bank is the only use case? No, because if the bank is the only use case, then it's a bank project. It's not a venture. So it's a little bit on our ventures, and you know, if a few of my ventures are here, they can tell you the I shouldn't say the pressure we put on them to get clients outside of the bank, right? Because it's absolutely vital that in order for them to succeed, that they can't just rely on the bank. So that's, you know, that's the way we run our ventures. That's the way that we recommend that they run their business. I don't know for you guys, but
I think we work a lot with startups, and I think one of the red flags that we get typically is if we're the only client of that startup, it's a red flag for us.
Yeah.
Because essentially we know that if anything goes wrong, we might have to bail you guys out, for example. But I'm not saying in this case I don't think it was right in that sense, right, to be able to do something like this. But the reality behind it is that you have to optimize for the problem statement. That's what we were discussing earlier, right? Around optimizing for the problem statement rather than for the corporate itself. I think when we work with startups at least in our innovation organization, the goal essentially is we can't build. The reason why we work with startups is we cannot build fast enough. We might not have the know-how to be able to do it. And finally, I think it's really about how do we bring something to life within the organization that solves the problem itself. But I'm sorry to hear about it, but it's quite a negative example. But I would say that it doesn't happen all the time, to be honest, for startups working with corporates. Because the reality, we just don't have the know-how to do it.
All right, I think, thank you very much for that.
one more.
Sorry, we are out of time. I'm so sorry.
We can network afterwards?
Yes, I
or
was
did
just
you
gonna
want
say, yes.
just maybe one more question? I think one
Okay,
more
fine,
question.
one last question. Sorry.
Hi, thank you. I'm Mathieu Loin from the French Public Investment Bank. I have one question, is that on your different cases, at the end you want to make the more profitable investment, or you want to drive the best transformation in your company? Because this is very, very hard to manage both.
Well, I don't know if I would agree with that statement. I think you need to be focused on both. You need to be able to transform the core while innovating outside and making sure that what you are innovating for is profitable. And that's how we are set up from the day one. We're not just doing strategic projects, we're doing strategic projects that need to be profitable, maybe not from day one, but that need to have that profitability.
I would echo the same. The only difference is the strategic ambition has to be very clear. Financial returns will take care of themselves. If you have a again, going back to the if you have a clear problem, a clear solution, and a pathway to get there, and you've got a credible team in place, you're going to get the financial return. If you don't, then none of that will happen anyways.
I just want to call out profitable. It needs a bit of unpacking as well. I think sometimes it's the amount of market share. It's a time frame to profitability. As with all things, you may burn for acquisition versus scale for profitability. Literally cash flow and margins and things like that. So you want to be very sure what we're trying to optimize for. But long story short, I think the two factors for the long haul do have to come together.
Okay, we can continue
All right,
the
yes,
conversation.
I was going to say,
Yeah.
thank you guys, and I want to thank the panel for all the great discussion. And thank you.